Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number 1 from the New Zealand Herald on the 4th of July, government to flood cities with more housing by liberalising planning rules. Topic number 2 from Oneroof on the 2nd of July, banks pick the date of first interest rate cut. Will mortgage pain ease this year? Topic number 3 from the New Zealand Herald on the 2nd of July, new building consents take a tumble. Topic number 4, the Mortgage Mag, 3rd of July, new code brings common sense to lending, FSF. And topic number 5 from the RNZ on the 2nd of July, Australian New Zealand property markets face creeping climate risks. So we'll start off with topic number 1 from the New Zealand Herald on the 4th of July, government to flood cities with more housing by liberalising planning rules. Housing Minister Chris Bishop will reveal plans to expand land for development to address New Zealand's housing crisis. The reforms will strip councils of their authority over urban boundaries and development standards, requiring them to plan for 30 years of housing growth. In a speech to the Real Estate Institute of New Zealand, Bishop will outline changes aimed at making land more affordable and easier to develop into housing. The government will eliminate councils' power to set fixed urban-rural boundaries and mandate development standards, such as balconies and minimum floor areas. Bishop argued that current rules increase costs and limit lower-cost apartment supply, defending the changes by comparing small apartments to even smaller housing alternatives like cars or emergency motels. The government will also fulfil its coalition agreement with ACT by making the Medium Density Residential Standards, or MDRS, optional for councils. A significant shift involves requiring 24 councils representing major cities to zone for 30 years of housing growth, addressing a previous national pledge criticised for redundancy by cities like Auckland and Christchurch. The updated National Policy Statement on Urban Development, or the NPSUD, will enforce live zoning for feasible development capacity over the next 30 years instead of 3. Bishop will stress that these changes will open up more development opportunities, driving down land prices and housing costs over time. Councils will have to meet high demand projections for housing and zone density around strategic transport corridors. The government will also make it harder for councils to avoid liberalising planning rules, ensuring infrastructure costs of new developments are covered. Bishop will assert that councils will no longer impose hard rural-urban boundaries, allowing city fringe developments as long as they cover infrastructure costs. Topic number 2 from Oneroof on the 2nd of July, banks pick date of first interest rate cut. Will mortgage pain ease this year? Many homeowners hoping for lower interest rates may have to wait until next year, as most of New Zealand's bank economists predict that the OCR, the official cash rate, won't drop until February 2025 at the earliest. Despite concerns about sticky inflation, none of the economists expect the Reserve Bank to raise rates further. The next OCR decision is due on July the 10th, which is just before Q2 2024 inflation figures are released. In Q1 2024, inflation was 4%, above the Reserve Bank's target range of 1 to 3%. Across the Tasman, the Reserve Bank of Australia has kept its cash rate at 4.35%, with inflation sitting at 3.6% above its target band. In the UK, inflation has fallen to 2.3%, but core inflation, still being high, makes a rate cut unlikely. In the US, better than expected inflation figures have raised hopes for rate relief. Kiwibank predicts the first OCR cut in November this year, so November 2024, anticipating inflation to ease back within target and economic conditions to weaken. ANZ's forecast a cut in February 2025, expecting inflation around 2.6% and unemployment by 5% by then. ASB also forecasts a February cut, with a chance of action as early as November, depending on economic indicators. BNZ's chief economist expects a cut in early 2025, noting deteriorating economic indicators alongside persistently high inflation. And Westpac agrees on a potential February 2025 cut, emphasising the need for clearer inflation trends before any decision. Now, I'm sure I saw an article this morning from BNZ saying that they actually think that there's justification for the Reserve Bank to start reducing the OCR sooner rather than later. I'll see if I can dig that out and make extra comments on that for you. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and an experienced property investor, and these events are available either live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Topic number 3 from the New Zealand Herald on the 2nd of July, new building consents take a tumble. New housing approvals in New Zealand slowed down recently, but the decline is not as steep as before. Stats NZ reported that in May, the number of newly approved homes fell by 1.7%, following a 2.1% drop in April. Over the past year, until May 31, a total of 34,851 new homes were approved, which is 23% less than the previous year. This means that there were 6.6 new homes approved per 1,000 residents. In May alone, 3,175 new homes were approved, including 1,555 standalone houses, 1,424 townhouses, flats and units, 109 apartments and 87 units for retirement villages. Stats New Zealand mentioned that monthly approval numbers can change a lot because of when big building projects start. Satish Ranchod, a senior economist at Westpac, said although fewer approvals happened recently, it looks like things might stabilise. He explained that higher building and loan costs, along with the soft housing market, are affecting how much new homes cost. Ranchod thinks construction will stay slow in the next year because interest rates will probably stay high. In Auckland, 14,488 new homes were approved in the year to May 31. In Wellington and Waikato, there were 25% and 36% fewer approvals. The rest of the North Island saw an 18% drop, and in the South Island, Canterbury had 15% fewer approvals, while elsewhere had 17% fewer. Stats New Zealand also said that non-residential building work approved in the past year was worth $9.2 billion, which is 7% less than the year before. This news comes just as Infometrics warned that house prices need to drop by at least 16% to be affordable, which seems a little bit outrageous to me. I think potentially it's more along the lines of, people's incomes need to increase a little bit rather than house prices falling further. But obviously giving people pay rises is challenging in the current economic conditions that we've got. And the Real Estate Institute reported that prices are now 15.9% lower than they were at their peak in 2021. Topic number 4 from the Mortgage Mag on the 3rd of July, new code brings common sense to lending, FSF. Lenders are relieved that the new Responsible Lending Code, which is part of the government's amendments to the Credit Contracts and Consumer Finance Act, the CCCFA, contains no unpleasant surprises. This new code aims to improve access to home loans and other types of credit while enhancing customer protection. The initial phase of the reforms ensures that lenders continue to act responsibly without adhering to rigid one-size-fits-all process. The government has also enhanced dispute resolution mechanism, exempted councils from the CCCFA to allow them to offer low-risk financial products for energy efficiency improvement, and eliminated redundant reporting requirements. The Financial Services Federation, FSF, expressed satisfaction with the balanced approach of the new code, which maintains consumer protection while allowing responsible access to credit. FSF Executive Director Lynn McMorrin praised the Commerce and Consumer Affairs Minister Andrew Bailey and his team for timely releasing the new code, set to take effect on July 31st. This will provide lenders with clarity on the level of discretion they can exercise in their affordability assessments. The previous affordability regulations introduced in December 2021 were highly prescriptive, significantly slowing down loan processing times and making it unfeasible for many providers to offer small loans. This left many people unable to access safe credit options for urgent needs and forced them to turn to high-interest loan sharks. Under the new code, lenders are still required to make reasonable inquiries into customer affordability. However, instead of following a strict checklist, they'll be guided by responsible lending principles, allowing for more tailored affordability assessments. The FSF supports measures to protect vulnerable consumers, such as defining high-cost lenders, but advocates for a more sensible approach that doesn't treat every customer as vulnerable by default. In the second phase of CCCFA changes, the government will review underperforming areas, including liability settings and disclosure obligations, and ensure adequate regulation of high-cost credit practices. Topic number 5 for this week in review from RNZ on the 2nd of July, Australian and New Zealand property markets face creeping climate risks. When floods hit Lismore, Australia 2 years ago, Adam Bailey lost all the historic collections from his antique store, including rare World War I photos of the Dardanelles. Ensuring his new store would cost almost 80,000 Australian dollars, which is a sum he can't afford. Bailey, a Lismore resident since 1988, now lives above his new store and is uninsured, fearing another flood could ruin him. The devastating floods reduced property prices in low-lying Lismore by 30%, illustrating the increasing risk climate-related disasters pose to real estate markets in Australia and New Zealand. Experts warn that climate change is a risk not accounted for by many home buyers in both countries who seek homes near water or bushland. Climate risk specialist, XDI, predicts that natural disasters could cut $800 billion Australian, or 6.7% from Australia's housing market value by 2030. In New Zealand, research by Climate Sigma indicates that about 20% of houses are on floodplains. Carl Mellon of XDI notes that while the overall economy might withstand these impacts, some communities will suffer more than others. Australia and New Zealand's real estate obsession has led to record home prices, with wealth heavily invested in properties near water, increasing risks for the economy, banks, and individuals. Australians hold the second highest real estate wealth among OECD nations, while New Zealand is also above average. Currently, there are few signs of systemic issues in the housing market due to climate risk. In Halmoana, New Zealand, a beachfront property sold for just 100,000 New Zealand dollars, less than half its government valuation, partly because the house was demolished. Research by property website Domain shows that increasing bushfire risks decreases homes' values by 2%, and each percentage point rise in flood risk lowers property values by 0.8%. Rising insurance premiums are making it hard for some homeowners to protect their properties. Allianz Australia revealed that 74% of customers with the highest flood risk did not buy flood cover last year, up from 63% previously. Insurance premiums jumped 16.4% in the first quarter of the year, the largest annual increase in 23 years. In New Zealand, about 1,000 properties are now uninsurable, prompting authorities to buy them after major floods in 2023. Kerry Watt of the Reserve Bank of New Zealand says insurance premiums have doubled in the past decade due to rising climate risks and construction costs. He urges buyers to consider specific property risks more carefully. Despite these risks, property prices in most flood-prone and coastal markets in Australia have rebounded, driven by strong demand and low mortgage rates. Even in Lismore, investors are buying properties at significant discounts. For some, the desire to live near water outweighs the risks. To avoid risks in property investing, do your research thoroughly before buying and work with professionals so you get a better understanding of your investment. If you want to learn about investing in property, join our free event, How to Succeed with Property Investing. During these 2-hour workshops, we cover recent property market data, and what's more, as an experienced property investor and a financial advisor, I'll be sharing valuable insights and expert tips to help you on your journey. There are ways that you can reduce risk in investing in property without becoming completely paranoid about things like global warming. But yeah, we'll take it as part and parcel of the process of purchasing. Our free events cater to all levels of property investors and first home buyers, and I'll tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today, secure your spot, register for one of our events, or alternatively, book a no obligation phone call or meeting with my husband Paul Roberts through our website. Thanks for listening.